Critical Solutions one more meeting at WRC. Today's speakers are Santosh Mallar and RC Joshi. So without wasting any time further, Mr. Santosh can start.
Thank you, sir, and very good afternoon to all the participants and those of us present here in the room. My session is the first session. I have covered basically 3 topics broadly. The first one is with respect to RBI's draft guidelines with respect to project loans that is applicable for banks, NBFCs, and housing finance companies. Whilst this is a draft guidelines, friends, there has been a lot of ruckus in the stock market. It was issued on 3rd of May 2024, I'm sorry. And thereafter, a lot of banks and NBFCs share prices have got affected. Basically, we'll take a we will take a kind of a overview of this draft guidelines and the concerns that the RBI has communicated. The second subtopic is again from a IFRS landscape. This is not Ind AS, mind you. This is IFRS. This is a very recent IFRS, that is IFRS 18. How profit and loss accounts should be assessed, should be analyzed, and how it should be presented can be a very subjective matter. Many companies, apart from the financial results and financial statements, give in their investor analyst presentation a lot of non-GAAP performance parameters. Example, banks and NBFCs give net interest margins, which is not part of the main financial statements or financial results. Telecom companies give ARPUs or average revenue per unit, which is again doesn't form part of the financial statements as such. And therefore, a lot of these non-GAAP parameters, non-GAAP as in it's something which is derived from the financial statements but not part of the financial statements, can be very important, but they are not subjected to audit or the rigor with which one should calculate this. Somebody can include operating profits. It can be so if there are some one-time gains or losses, it can be included. So there are no parameters, there are no framework that how you should go about calculating this. So globally, there was a concern that there can be confusion, there can be diversity of practice because there is no standard with these things. And therefore, this is one step closer to getting a uniformity in this financial reporting as to what this new standard does. It doesn't lay out any new rules of accounting or nothing new. It simply requires the profit and loss account to be kind of codified in a specific manner to make it more easier for users to read and make it more comparable with industry peers. We'll see how that we'll have I have a few slides on that, so we'll just take a look at that. And the third and the last topic is again a very, very interesting update with respect to SEBI market rumors. So we all know that in December 2023, SEBI came up with a circular requiring top 250 listed companies by market capitalization to confirm, deny, or clarify on any market rumors with respect to the companies. Today, as we see, if there is a business, newspaper, there can be some rumors which can be, printed in the mainstream media. Of course, there can be a lot of rumors in social media, WhatsApp groups, Telegram groups, etc. So this circular, which came in December last year, it put a sense of accountability on the company's management, a very onerous responsibility to either deny, clarify, or confirm the rumors. Many a times those rumors can be, more of market sentiments. Many a times it can be something which the company ought to be clarifying. For example, if there is a rumor that a particular company is acquiring or is in talks, as per sources, it's acquiring another company. That can be a very, very price sensitive rumor, and therefore the company ought to clarify that no, this is not true or this is true, whatever, either ways. So that was deferred later because the operational part, how it has to be clarified, what is a market rumor, what is a price sensitive information, all those things were not clear. The SEBI had formed had deferred it for the time being, and it had, set up a internal committee to study the finer points of those requirements. So as a part of that exercise, they have now come up with a clarification. This just came, Manojji, last, couple of days back. This was just on Monday that it came. And in a lot of, as you know, this is the audit committee season. A lot of independent directors are, in fact, very much interested in this particular thing. So, for example, I'm just giving the introduction. So, this circular actually clarifies a few very, very critical aspects. Although it has an annexure which is still, at least to my mind, it's still quite, complex. But at least it's one step by the regulator and, clarification. So, friends, with that little background, I will start with the first subtopic for the day, at least for my session. We start with the project under implementation draft prudential framework of the RBI. So basically, the preamble, as the central bank has explained in this particular draft circular is rather circular, which has the draft guidelines, is that apparently the Reserve Bank is the mindset, the perception that it has at present is the real estate prices are all, it's infrastructure loans, a lot of focus is on the infrastructure projects. Banks and some of the NBFCs have a lot of loans which are, for project loans, and these loans, depending on the business cycle and the general market, general business cycle, it can be very sticky. So, with this background, they have come up with this draft guidelines. The comment period is until 15th of June. That they want all the banks and NBFCs to, by default, say that whatever project loans or infrastructure loans are there, 5% would take a straight away a provision, a general provision, irrespective of whether there's a default, whether it's a standard, substandard, all those rules are there. But the overarching requirement which they want is, if it's a project loan which is under the scope of this circular, by default to make on day one itself 5% provision. 5% provision can be a very significant amount, because if you look at the banks, NBFCs, the GNPA ratios are one of the most critical parameters of assessing the quality of assets of any lending company. Therefore, this 5% can be a very, very significant amount for many banks and financial institutions. So these directives lay down are issued to provide harmonized prudential framework for financing of projects in infrastructure, non-infrastructure, and commercial real estate sector by regulated entities. As we all know, regulated entities means that it's banks, NBFCs, urban cooperative banks. So collectively, RBI refers to them as regulated entities. these directions also lay down the revised regulatory dispensations for changes in date of commencement. So again, the circular is very skeptic of scenarios where the commercial operations of any infrastructure project or any project has been delayed. So beyond that, if there is any restructuring or if there is any scope change or if there is any deferment of DCCA, the general tone of the circular is the bank, the lending bank or NBFC has to be very skeptic. And even if it's a performing asset, maintain at least a 2.5% provision, a general provision on based on precaution, abandoned precaution. The circular identifies that each infrastructure project can have 3 phases broadly. The design phase. This is the first phase which starts with the conception of the project and includes inter alia the designing, planning, and obtaining all the applicable clearances or approvals till the financial closure. The construction phase, this is the second phase which begins after the financial closure and ends on the day before DCC. The last and the third phase is the operational phase where actually the project starts generating revenue, starts operations. So basically, as I said earlier, these directions are issued to provide harmonized prudential framework for financing the projects in infrastructure, non-infrastructure and commercial real estate sectors by regulated entities. These directions also lay down the revised regulatory dispensation for changes in the date of commencement of commercial operations of such projects in the background of review of the extant instructions and analysis of the risk inherent in such financing. The key proposal, the first one is all lenders shall maintain provisions on exposures to project under implementation at various stages as under. The first one is construction phase. So during construction phase, a general provision of 5% of the funded outstanding shall be maintained on all existing as well as fresh exposure on a portfolio basis. So Manojji, for a bank or NBFC, this 5% can be a significant thing, right? And when this circular was issued on 3rd of May, subsequent couple of days, a lot of banks, share prices, bear the brunt of, hitting the lower circuit or whatever. So 5%, what are your thoughts on this, 5%? How did this magic number of 5%? Why not 3%? Why not 2%?
Well, I'm told a lot of board members, chairmen of listed banks and CFOs interacted with me. What they said, they were aware of this coming because the regulator wanted to strengthen the balance sheets of banks. And if not now, then when? Because the CapEx cycle has started for infrastructure. So there is heavy investments. So there is concerns about the past, which fund. There was a lot of NPAs because of infra loans. So we have among the best regulators in the world. So they had prepared some of the top banks.
But do you think this will be an impediment when it comes to, so there is a lot of focus on infrastructure in our country since last, recent years, and it will continue to, right? So will it deprive infrastructure, projects from critical financing?
No, very clearly,
Okay.
Because the top leading banks are not saying we will not give fund. It is only a matter of the cost of funding.
But the credit cost would significantly increase.
It will increase.
The GNPA ratios
It
will
will
increase.
increase for banks where concerns are there in terms of rating. And some limited amount is there, like one leading bank, it has come in the Economic Times today. Now impact is 9,000 crores. 9,000 crores on the largest bank.
Impact of this circular.
Yes, in terms of extra provisioning. So on the capital requirement, it does not have much impact at all.
For a large bank, 9,000 crore may not be such a big amount, but for a medium-sized bank,
The percentage is very low. It is only on infra loans. And that also, the basis points is less than 50 basis point impact. And it's a pass-through mechanism. Now, whether the bank bears the additional charge due to additional capital requirement, and we have to keep in mind this is only a draft consultation paper. It is not final.
Indeed.
It's draft, and the regulator has also said they have an open mind, and they want the views. It is like that India's consultation paper. It came how many years ago? Over 5-6 years ago.
Reminds me of the ECL. Reminds me of the ECL proposal for banks, which again has gone for cold storage. Manojji?
It is not in cold storage. It is got on the agenda. Even yesterday, our top chairman of the bank told me on India's impact, and he says we will benefit by India's because we have done extra provision. I'm not leaving the chairman of the bank now, but it is a listed bank with over 1 lakh crores in deposits and over 40% CASA. They said they benefit. So because of the strengthening of balance sheet exercise, the regulator has prepared them for. It varies from bank to bank. That tier 1, tier 2, there is a lot of deep dive and we go into it, it is there. But this has been taken just some suddenly. It needs preparation. So if it is a draft consultation paper, hopefully it should not come from 1st of July or 1st September. It should be phased out in consultation with the bank. So it doesn't hit the customer, it doesn't borrow the extra loans.
The cost of borrowing for infra.
Cost of borrowing, and it should not affect the project. If the project is not viable, fine. Then you make it viable. But no project will not be viable because of a few basis points interest increase. Efficiency and deployment of capital and completion of projects in time is vital to this.
Right. But do you think, basis some of the media reports and some of the speeches of the governor, central bank sees any contagion in the entire system?
Not at all. It will,
The result of that?
it will make the balance sheet of Indian banks healthier, far better than the European banks and US banks, and also the Chinese banks. So no better time for Indian balance sheets to become stronger, and market knows it all. There was a knee-jerk correction after it was clarified. The Bank Nifty is at an all-time high. Correct? Bank Nifty is at an all-time high. So this is an advantage with the private banks and public sector banks which are doing infra lending or also rated very highly because of a very mature response to the regulator, and regulator has also given a very mature response to the bankers and NBFC's view.
My own take, Manojji, and other is that for NBFCs, this has a very limited impact. Basically, because as we know, the NBFCs, the top NBFCs and the listed ones, of course, do follow the expected credit loss provisioning model, which anyways requires you to anticipate future losses based on a forecasted model. And therefore, this 5% on project loans, because project loans anyways are, even by the the financial services sector, is also it's perceived to be high risk because of the implementation periods that you have. So anyways, the ECL provisioning takes care of this. Of course, from IRAC provisioning perspective, this is going to have an impact. But anyways, from a P&L perspective, the NBFCs would have a very limited impact on account of this.
But I would like to your view. One is on the impact on financial statements. Another is this provision will require additional capital for NBFC. Additional capital is very important. It impacts the lending and debt equity ratio and also the cost. What will be the impact on some of the top NBFCs in terms of additional capital requirement, and how much impact it will have on the profitability?
So if one looks at the NBFC, the loan portfolio that the most of the top 10 NBFCs, we have in India, primarily it consists of retail loans, because as we know, of course, there is again a different concern that the RBI had. But Today, Manoj, the general perception in this sector is that retail loans are much more lucrative, and because of the technology and the algorithms that etc. Is working, it's very easier. It's easier to penetrate in the sector and get more net interest margin.
But I would say.
But having said that, if you look at the top four NBFCs which have significant wholesale loans or project loans in their balance sheets, if you look at their credit risk disclosures in the financial statements, or even for that matter in the investor analyst meet that they publish, they already have a management overlay provision of 7 to 12% of the ECL provision. So somewhere, the NBFC sector, and at least these top four NBFCs, top four not in terms of ranking, but the top four which have the real estate developer loans, they have already built this up in their provisioning metrics. In fact, a top, CFO of a top NBFC, he told me that this, in fact, 5% is much lesser than what we provide in our books. This is the, back of the envelope calculation that those guys did. And in fact, they went to the, in the March the analyst meet that happened in that NBFC post the March results, the board meeting. In fact, they declared to the analysts that and investors that this has in fact almost a nil impact on their balance. So, answering the first question, my take is that not much impact on NBFCs, and since there is no P&L impact, it would have very, very limited impact on capital adequacy. As against the December 2023 circular on retail loans, you may recollect that in one of such meetings, last time I had covered a similar circular by RBI. It was not a draft circular, it was actual circular, wherein it raised the risk-weighted provisioning by 25 basis points. So 125% increase in the retail loans. That has hurt the NBFC sector much, much more than what it has. This proposed thing. So my take is for NBFCs not much of an impact, but the banks much higher impact. But of course, as you mentioned, not a very significant bank. But we all know that in our country we may have a few banks which are relatively weaker. So
about our interaction with the chairman and the CFO of the topmost bank in the country. Now, last week, the largest NBFC in the country, the CEO and the CFO had a one-to-one interaction with him. Also, the additional secretary power. In fact, he has shared his mobile number also with me. And normally they don't share it because a person who is a director on the board. Now, there is impact on NBFCs. I'm talking about the largest one, who are engaged in power finance and rural electrification throughout the country. The CEO, and the CEO is very, very, very articulate. It's a pleasure for a professional HRs to interact with the CEO. They invited me to the office, also in Delhi, to a regular interaction. And there is impact. They said they are evaluating the impact and would engage with RBI, and they don't want to increase the cost of finance immediately, so the customers should not get affected. Not only that, they said they have about 1/5 of their loans from foreign currency, and that hedging cost is also to be considered. And ultimately, those loans already cost is there, so they will not pass on increased cost, because in infra, worldwide, a few basis points also makes an impact. Absolutely. Particularly, there are long-term projects, bridges, highway projects, there are bullet train projects. Absolutely. And there are other public sector NBFCs who are jobs by the mandate given by government is only infrastructure finance.
So, but then in that case, Manojji, anyways, in the IRAC norms, even today, there are a lot of carve-outs for government-owned NBFCs. a lot of relaxation anyways have. So you're right. So the government and the central bank generally for those reasons that you mentioned, the government owned NBFC is a different story altogether. There will be relaxation because the projects that they fund are
But
nationally very
these are
critical.
listed ones, finance by private and foreign banks also, and they are autonomous. They are told to compete on a level playing field at all. So they are engaged with the regulator and in their own interest because profitability matters and also the viability of the project.
My sense is there will be an exemption for those. My sense is they will get an exemption for valid reasons, for right reasons.
Or maybe the implementation of circular will be timed out, phased out.
Yes.
Hopefully that happens. So it's a consultation with stakeholders and since anybody can give consultations, all the experts and members here can also, in their own capacity, can also give a response to the regulator.
One thing I want to tell you, yes, there's earlier power projects, were mostly government power projects, right? Now, when they invited, as you said, it is very long term. Now, if project being implemented, which is 3-4 years, and project which is very long term, right? If you see the example of that, right? They jumped into power sector. They were, the focus area was electronics, right? And they jumped into power project. Thereafter, there are many corporates, that went into power projects, but because of this length of the projects, so and that return, it is unlike other industries, right? So they definitely suffered actually, and they suffered their own basic activity also.
No, we absolutely right, sir. I agree. Unfortunately, in our country, many corporates did digress into some of the businesses which was not organic or not integral to their operations.
Yes.
A lot of companies did go for power for the tax benefits that came in 19 and in 2000s. But many of them have actually gone their fingers, and they basically classic cases that of this solar power projects. So when the solar wave started in India, the per unit tariff that on an average people were getting was in the range of 8.25 and very soon, within a time of 4 to 5 years, the bidding which happened by NTPC was in the region of 2.5, 2.7. Where is 8 and where is 2? So very fast, some of these projects became, unviable, and it was a very difficult scenario for those guys.
In my banking career, I received a power project, and that meeting, as usual, we keep it in 5-star hotels, right? So we were invited, and I think whether I can name IDBI or not. The power project was authorized by IDBI, right? And it was held in 5-star hotels. Now, when I inquired, it was very large project. Their basic activity was into this leather items, right? So there are 3-4 items. When we inquired in this meeting, number one, it requires a term loan. So they have to bring in margin. So therefore they will bring margin. So they said they will bring margin from their associate concern, right? That is first thing. Then we have already studied that to whom they are going to supply this, right? They are having very low rated, right? So they will default, and this ultimately this also will suffer, right? Another thing was that they don't have any key related to this side. Now, when I was finalizing the proposal, the consultant concerned used to visit my zonal head, and then below that, and then they said, okay, he's doing this. I am preparing, right? I was very sure because our boss was getting calls from KWC. Can you speed up this proposal, right? Then what happened? If that man came to me, then he said, okay, what is the status and all that? No, I am preparing. I did not ask him or told him anything because I am going to give to my boss.
right? So they will take it ahead. Because I know how much pressure was from head office, right? So I prepared and it was not for sanction, right? So it will go to central office with recommend not to sanction like that, right? So it becomes more tricky when you put these words, no, in large proposal, right? So I did not tell that guy anything. I gave to my boss. My boss go to Jedam to his home. After Monday, he came and he said, okay, one or two changes is suggested, right? He said, okay, head office, there is a lot of calls, so better we prepare this way. So we have for negative also you have to prepare well prepared, but not to sanction. Right. So we have negated once this
No, but what happens is that, as you say, for various benefits, tax benefits and diversification, no? So when their present business is doing good, and then they fall into this trap. Let's say poor parent a long time back, I remember they also went to the power. Now I'm coming to a kind of a customer side of the issue. Suppose these provisions are to be made by all these banks and all these regulated entities, then will not it increase the cost of projects and will not it hurt the India growth story?
So absolutely. So my sense is that for that reason, as per my estimates, the government-owned PSU NBFC will be probably kept out of this, although there is no mention of that in the draft.
Moreover, the example that I was giving, therefore we will bring the margin, right? So what they in meeting is that we are associate concern will provide, right? Luckily, I was in Hong area, and their bank also is in that area only. So in the afternoon, I went, I met not this person is handling a meeting. This because we have got that associate concerns. I got no. That is why this power project presentation we were not invited. Our bank was not invited because they are already having weakness in this account. So there is no margin that they will be able to provide. The government they to bring in one margin. No?
So, so absolutely coming back to your point, sir. So see today in let's say real estate development finance, anyways the cost is extremely low. You're talking about bank loan of to a real estate developer. You're talking about interest rates in the region of easily 18 to 25% per annum. So this 5% is something which will further increase this. So I think what the Reserve Bank is wanting the banks to kind of nudge them not to have too much of focus on project loans.
And due diligence also is a key. Without all the projects, all these infrastructure and power projects are not bad. They are also good. So it is like again promoter to promoter, customer to customer, and the viability. What is the model they have come out with, and what they are substantiating. So actually, the evaluation is more important rather than simply across the board.
The underwriting has to be very strong.
Yes, yes.
Key whole thing, but I think the concern also stems from the fact that, unfortunately, in our country, we see a lot of project loans delays. There is a lot of focus on VCCO deferment in the draft guidelines. So invariably, if there is a delay, there is a high risk of delinquency, and therefore, I think that is because approvals take their own time. We have multiple approvals that we need to have, state government level, municipality level, central government, environmental, clearances. At various stages, there are delays. Simple building redevelopment in Mumbai, one of the most urban cities in the country, we know that what kind of issues a project can face, and therefore invariably there will be delays. So I think that is the whole thing, but it's a vicious cycle. Like if the more restrictions you bring, the cost of funding will increase, and the more they may go for the cash transactions, etc. Otherwise, how will you?
And will it really improve the quality of the projects, which I believe may not? Because it doesn't really put pressure on those type of, say, I would say, level 2, level 3 kind of players. Like, some people want to take risks and some people have different interests into the project. Like, so, I mean, the good project, the good management and good groups, they will be always doing in the way, whatever is required. And they will be, more keen that because they name it as a stake, they will see that the projects are through. And there will be having better financial strength and all that. So ultimately, I don't think that projects for infrastructure and real estate and all, they are different types. Yes, with a longer decision period and the returns are also not that attractive. But then ultimately the country needs it. So somewhere some balance has to be struck.
Absolutely. So with that, I think we move on to the next topic, next subtopic, at least in my session, that is on IFRS 18. So a snapshot of what we have. There are new subtotals in the P&L. There is a defined term of operating profit. The P&L, so I'm looking at the first box on the left-hand side of the slide. The P&L is classified into 3 brackets, that is operating, finance, investing and financing. Today we know that cash flow statements have this segregation, not P&L. P&L, while Schedule 3 gives a format for, presenting P&L, but within that, whether it's an operational activity, whether it's investing, whether it's financing, that's not something which is mandated. There is no codification of that kind of a thing. And many a times, practically, at least I as an auditor, many companies know that many clients face this issue. If there is an exceptional, item or one-off item, whether it's part of my top line, whether it's a expense or whether it's a other income, where do I put it? Right. So that is generally a kind of an issue. And because listed companies in particular or even non-listed for bank financing, they are focused on the ratios, the profitability ratios and, debt equity, etc. Where in which, how do you classify those income or expense becomes a very crucial kind of a thing. And therefore this standard intends to address that issue, that there has to be a kind of a codification of the P&L also. The second important aspect is the non-GAAP measures. As I said in my beginning, preamble, that a lot of times there are industry-specific non-GAAP measures. Many a times there are, generic, sector-agnostic measures. Many a times you do have return on capital, employed or those kind of ratios. They don't get disclosed in the main financial statements or the main financial results, and therefore the scrutiny and the level of scrutiny that they are subjected to is not as much, right? So many banks or NBFCs, for example, publish their names, they publish their number of branches they have, they publish the profit before credit cost. So they publish credit cost in the analyst presentation, not in the main results. So how they calculate that? Another thing that comes to my mind, Manoj, is this collection efficiency. I know for a fact that amongst the banks and NBFCs, there are at least 5 methods in the market on how to calculate your collection efficiency. So in a particular quarter, depending on what story one wants to build, the calculation can be, and there is no concept of consistency or comparability in all that. So what this standard again proposes requires is that whatever non-GAAP measures you have as a management, you need to also include that in the main financial statements. Consequently, they will be also subjected to audit, and therefore there will be a lot more scrutiny and consistency and comparability when it comes to non-GAAP.
Does it mean can be required for a guidance note on the method of collection?
There is already a guidance note that the institute is working on. Manoj. The US FASB and the PCOB has its own requirement when it comes to non-GAAP measures. The institute has already come up with a paper on non-GAAP measures in the context of the ICDR requirements. So, for example, as you know, many IPOs are floating in the market today, right? Almost on a weekly basis, there are 2 to 3 IPOs. In the DRHP, many a times there will be non-GAAP measures. For example, it can be anything. It can be number of hospitals. It can be number of hospital beds. It can be for one of the housing finance companies IPO that came a couple of weeks back. It was also the collection efficiency, etc. That gets published in the DRH.
The requirements of industry.
The institute has rightly so come up with a guidance on what is it that you are supposed to do with that. Internationally, of course, there are a lot of literature, but once this non-GAAP measures make their way in the main financial statements, there will be a lot more guidance and auditing standards that will be required. And absolutely, you're right. How to calculate consistency, क्या denominator में लेने का, नहीं लेने का, that has to be codified. So absolutely point taken. The third important thing is the greater disaggregation of information. Lot more transparency in the P&L. That was after all the intention of this project. The fourth is enhanced guidance on how group information within the financial, how to group. So one thing is on disaggregating, one thing is on aggregating or grouping. And the last is the main business activity that drives the classification of the income and expense. So if I'm earning interest from, let's say, income tax refund, that's not my main kind of a thing. That's an incidental income. So that will not be forming part of my operating activities. But if I'm getting, if I'm an investment company and I'm getting interest on my bonds or interest on my FD, in that case, that will be operating. So again, depending on what's your main activity, the classification will go by that. So again, a very helpful, and timely guidance that they have come up with. I again repeat that this is not an Ind-AS standard yet. This has come internationally. This is effective from 1st January 2027. Internationally, as we know, the ISB follows a due process, which means that whichever standard comes, at least 18 months has to be given for people to understand. So you mentioned in the earlier subtopic the phase-wise implementation of new requirement. Internationally, it's followed. ISB doesn't come up in its due process. I think there is a requirement that you cannot mandate the application of a standard without having issued it at least 18 months before the standard comes into, was actually. So people get enough time to read the standard, to understand it, understand the operational aspects, the business aspects, what all information you need to collect. Auditors are, aligned. So after 18 months of preparation, that is only when you actually apply the standard. Earlier adoption is permitted, not mandatory. So this standard is effective internationally from 1st January for all the annual, financial years, starting from 1st January 2027. In India, the institute has formed a subgroup within the accounting standard board, and the deliberations have already started. The institute had also contributed in the comments, when it was exposed for comments, they had commented on certain aspects. But by and large, this is aligned except for a few things here and there. In this, my sense, and again, this is just my sense, this is not the official institution, but my sense is that there won't be any carve out from this standard to the equivalent in this 118 requirements whenever it comes. So let's deep dive into it. IFRS 18 introduces a defined structure of statement of P&L. The objective is to reduce diversity in the reporting of statement of profit and loss, helping users of financial statements to understand the information and make better comparison between companies. The structure is composed of categories and required subtotals. So as I said, there are three broad sections within which you will have to group your P&L into. We know that these categories do exist even today under Ind AS, under IGAAP, under accounting standards, in AS3, in Ind AS 7. You have to classify all your cash flows into operating, investing, and financing, right? But there is no equivalent requirement for P&L presentation. This standard now introduces that requirement for P&L as well. So operating category, what is operating? It's not defined in IFRS 18. This is a residual category, whichever, whatever is not investing or financing automatically becomes your operating. The second category is investing category, I'm sorry. This category typically includes results of associates and joint ventures, results of cash and cash equivalent. So your FD interest, assets that generate a return individually or largely independent other resources. So for example, if it's a manufacturing company which has certain flats which it has rented out, okay, whatever. So those investment properties, the rentals that it gets on those either commercial or residential properties will be classified as investing income. And then you have the financing category, that all income and expense from liabilities that involve only raising finance. So typically your interest payouts, your processing fees that you pay to the banks, your dividend tax. So all those all those items will be financing activities. So again, this codifies this. So what is part of your top line? What is part of your not part of your top line? What is part of your EBITDA? That becomes much more palatable through this new code that this standard has. IFRS 18 includes additional requirements for entities that provide financing to the customers, that is banks or NBFCs, or that invests in assets with specific characteristics, for example, investment. Some income and expense that might ordinarily have been classified in the investing or financing category, when applying the general principles, will be presented in the operating category for these entities. The results of this is that the operating profit, which includes the result of the entity's main business activities. As I said, there is a lot of focus on disaggregation of numbers here or subtotals. So IFRS 18 requires entities to present specified totals and subtotals. The main change relates to the mandatory inclusion of operating P&L. The other required subtotals are profit and loss, profit or loss before financing and income taxes, with some exceptions. For example, where a bank has financing as a main business activity and has made specific presentation for this. So this is how P&L in this new, under this new IFRS 18 will look like. So if you look at the main revenue, you will have the so the first 6 line items are the operating income and expense. So you have the revenue, you have the cost of goods sold, you have the gross profit, you have the selling expenses, you have the administrative cost, the R&D expenses, and that becomes your operating profit. So today, if you envision the results of the financial of the companies that we see, you see the revenue and then you see all the expenses. So the revenue is presented first along with other income, so total income, and then come all the expense head, right? Your costs, your employee benefit cost, depreciation, your interest cost, so on and so forth. And then you have the total expense and then you have the profit. You may have some exceptional item or here and there, tax, and then the PAT. This is a different P&L geography altogether. You have the top line, the revenue. Then you don't have other income. You have the cost of goods sold. And therefore you have the gross profit as a subtotal. You have the selling cost. You have the administrative cost. You have the R&D cost. So this is the operating profit. So this is basically the operating profit of the company. So if you have any associate joint ventures or if you have any interest income from bank FDs, that gets classified as investing, income.
This is more or less similar to CMA, that a large corporate.
Correct. This is much more useful in terms of the shareholders or the analysts, because otherwise,
So they
what to
other
include in operating profit, what not to is
Yes.
up to the management, because it's not a defined term. Absolutely. And then you have the interest expense on borrowings or lease liabilities, which get classified as financing. You have the PBT, you have the income tax cost, and then you have the PAT. Then if you have any discontinued operation, again you will have a separate presentation. So, Manojji, do you think this is this presentation? So envision a P&L, let's say of any top profit, so that I know for a fact that you go through financial results very, very extensively, and you discuss a lot with managers who of the industry. So do you think this format will be, what's your take on this format?
This format doesn't take care of practical requirements of most of the top corporates, whether in manufacturing or in service industry and in emerging technologies companies. It's very difficult to put it in this format. There are a lot of emerging technology companies. We can just share whether it is Tesla or Facebook or Flipkart. Also, it has done placement to Google. And diversified companies, whether it is the topmost, let's take the top 50 Nifty companies, it's very difficult to put it in this format. And then the groupings take place. The auditors and the internal auditors both have to look at it, and classification, as you said, only collection efficiency. It is not a mandatory disclosure requirement as per NCA. It is demanded by the large investor stakeholders. So there are 5 different methods. So here there are so many issues in terms of whether we talk about Nifty 50 or CNX 500. This format is outdated concept of putting it. It needs total overall.
So you prefer schedule 3 format to this format?
Even schedule 3 is also, I feel it is defective. It doesn't serve the members. When it was done, at a time also all the suggestions are given, some are implemented, some are not implemented. So there is time for a total review of financial statements globally based on current requirement. It's a AI world now. I was talking to some of the CFOs just a few days back. There was a meeting at the Santa Cruz. And they said for a global company, US, AI tools were used to draft the notes for docs. That is happening. It has come to this stage. Actually, when I asked some of the CFOs, because I operate at a chairman level and interact with Dr. Chairman, I asked them whether the CFO should be replaced by AI. Do we see that word? And some of the CFOs who have worked with top listed companies, they said it is possible the CFO will be replaced by the AI world, but the CEO will remain. CEO or the chairman, at least one person, because he controls the software developer. and he decides which AI tool is to be used. So these are issues. AI can formulate even the notes of accounts. It is happening practically. Of course, subject to the decision driver, who may be a large company CFO or he may be the chairman or CXO of the company. But this is quite outdated. We are today in 2024, and we talked about some implementation being done. You said on 1st January 27, 25, 24, we are halfway through. 25, 26. So we expect a lot of changes in future, and it's a rapidly dynamic evolving world. And yes, but we have to be updated thoroughly. Like today we are meeting, we thought it is essential. These are the latest developments, so that we said, for Saturday, let us a meeting take place. We can't wait for another Monday or Tuesday, because decisions are done based on our interaction. And maybe you are going to implement something next week. This discussion is going to be useful. So, all will be having the benefit of it, watching it through the social media.
Right, sir. So, Manoj ji doesn't like this presentation. Any other thoughts?
No, the presentation is fine. Particularly this format. I am accustomed to this format because in bank, we receive this format only.
Standard committee norms, story committee norms had a format.
And this format only we receive. So for me, it is not a something new, right?
So Santosh, can I add something?
This is too simplistic a form.
Just, I think this, somebody is on the Zoom.
Yeah.
Yeah, just see.
So, I heard somebody is wanting to speak.
Somebody is on Zoom.
Santosh Nilanjan here.
Who is it?
Hi,
Nilanjan.
Nilanjan, how are you?
Always
Just
Santosh.
introduce yourself and speak. Yeah, just introduce yourself. Put your
Hi.
video on and speak.
Hi. So I am a bit on the way, so I'm not putting on the video. But as always, it was a pleasure to hear Santosh, and Manoj ji, always great to connect. So Santosh, I had
Absolutely. Right.
just preliminary thoughts on this, and I had a chance to quickly go through these requirements, or developments, as to say, from a Indian standpoint. So I think this standard doesn't change the way you compute a number, right?
That's right. That's right.
It only
The way you
changes
present
the
is what it
classification. Yeah.
Correct.
So I think one of the concern, which probably a valid concern, is that is it going to change the way I compute my PBT or PAT? The answer is no. It remains the way it is computed even today. The headings obviously change, right? So I think Manoj ji also wanted that point out, from a challenge in classifying or representing a particular balance sheet or a particular P&L. I think that point is well taken, but I think from a global investor's point of view, you as well, and in my interactions with other jurisdictions, the way we have a set format in India, in many jurisdictions they don't have anything.
Correct.
Right? So I think globally there is a unified or a common platform or a global alignment that the standard setter is looking at. That will, in my view, it will aid comparability, and it will also aid from an Indian new age entities to going out global, to have a much more easier way of investors approaching.
Right.
Secondly, what I would
like to acknowledge Nilanjan is the director of a professional firm which covers a good number of the top 500 listed companies, lots of listed companies, and has deep dive technical knowledge in financial statements at a highly proficient level. Thank you, Nilanjan.
Just to add, Manoj, he's director is not a normal director. He is a director in the technical desk in the professional practice group, which is the center of excellence kind of thing.
Exactly.
Great, Nilanjan, to have you on this call. Yes, sir. You had some.
Yeah,
Nilanjan, stay back and contribute to your ideas.
yeah. What I feel, see, what Nilanjan said is I agree that, at the international level and all that, they want to have some kind of a comparability between various companies. So that it will enable. But suppose somebody wants to do inter-industry kind of a comparison. So like say if you are talking about say Maruti versus say Mahindra and Mahindra or Tata Motors. Like so that all the expenses like cost of goods sold will be clubbed. Now, whoever has got any particular efficiency level or somebody is better than others in certain areas. How will that come out here? It is basically giving that what is the gross profit level and what is the profit before financing cost. So it only talks about the margin and then what is the paying capacity or other is the servicing the debt. So it suits more to those financials rather than somebody wants to take a decision for investment.
So I agree with you, I do not deny you, but today, I think where this is coming from is today, if you look at the at least around the world. Second is from the perspective of Indian context, which I envision Indian companies doing it as compared to Soviet Union. This gives a lot more insights on the performance of the company. So, for example, if today I have to find out the or let's say the gross profit of any simple manufacturing company, I want to guess and second guess. Okay, so I get the revenue from the P&L, but from the costs, from the movement of stocking, of the decrease in the stock, I'll have to actually work out what is actually the operating cost. Here, because it expands the concept to R&D cost or general administrative cost. So what the management perceives as its operating profit gets disclosed in the P&L, and therefore from comparability, your example Maruti versus let's say Mahindra and Mahindra. So both the companies taken together, operational profitability, I'll be able to better compare. So for a company may spend more on R&D, pharma companies for example, a company may spend less. That will come out quite clearly in this way. I'll have to take my calculator or as Manojji said, my artificial intelligence chatbot, that chat GPT and get to that kind of a calculation. So this serves the presentation on a platter to the investor. We can then probably do whatever. Yes, so I think my sense is this is a one step better in terms of the way forward. What is even more interesting, Manojji, is the format that we have, and that is illustrated in this standard for the finance companies, for the banks and retail banks, where it says that you have to disclose your NIM on the page of the P&L. Like you have the interest revenue, you will have the interest expense, and then you will have the net interest margin. Then you will have the fee and the commission income and the commission cost. So you will have the net margin on the interest and the fee and commission income, and then you will have the trading income. So and then you have a separate line item for ECL, the employee benefit cost, depreciation, so on and so forth. So again, it on the base of the P&L itself, the operating profit, the NIM, the net fee income will come out, and I think from a retail shareholder perspective, this makes much more sense in terms of of what is operating profit of a bank or a NBFC becomes a lot more palatable. Again,
yes, because see here there is a subjectivity in charging particular operating cost, right? Because we have even assessing also we have found out that some companies now they have very low cost for their employees, right? So they put director salary also in that item, right? Just to show that there were a lot of these expenses on this. Directors.
So this will just to kind of correct this doesn't change what is employee benefit cost or what is the nature of the cost. That remains the same. So if director's salary, if the directors you are talking about, sir, are the executive directors, उनका खर्चा will be coming in employee benefit cost. वो आगे पीछे नहीं कर सकते, ऊपर नीचे नहीं कर सकते.
This there was a variation last year just to suit their statement, no. of convincing, right? Last year what was, this year what, right? Right. So that is we found that.
Manoj, your take on this?
I think.
For NBFCs and banks?
On what?
This format on NBFCs for banks.
This is fair enough.
Okay. This passes the muster of Mr.
I'll tell you why. It really mentions from point of view of, I know people, one-to-one who have invested millions of dollars in Bharat. Control 1%, 2%, 5% stakes in top listed companies.
In Bharat,
In Bharat.
India.
Bharat. Some people call it India, some people now say it's a Dixit Bharat. And who control 4 to 10% stake also. They interact with me on a regular basis. Now, based on their expectation, it shows credit impairment losses, very clear line item. It's a very vital item
For NBFCs and banks, it is.
for the financial company. So you have interest revenue calculated using effective interest rate method. From view of uniformity. Some people take processing fee from 7% to build in their quarterly numbers.
Especially in a co-lending scenario.
Yeah.
You have all those kinds to avoid GST, a lot of.
Yeah, but I know this has been happening for last 30 years. There was no co-lending then. Because you need, when ESOP came, it started. So they are doing the quarterly profits.
Right.
So here effective interest rate method is a very important item on the top line. And fee commission income is a very vital thing because actual business, you can always have increased income by increase in rates, but your fee income shows operating efficiency and growth of the business. So that income takes care of, and then your trading income. Actually, the word trading is misnomer. It can be treasury income. I think it means treasury.
That's right.
But fair enough. Trading is a very well accepted international word for accounting terminology. It used to be trading and P&L account, if you remember earlier. When we started
Personal account and trading.
trading.
They're trading, for something different. This trading is different.
Yeah. So your bond trading, your bond equity trading, commodity trading now, credit impairment losses is a vital thing. Employee benefits are very vital, particularly this year we have seen there is a increase in the pension cost. So employee benefit expenses, depreciation fine, operating profit, share of profits of associates, interest on pension and leave, each and everything is vital in this.
All right. Great. Sir. Your thoughts, sir.
Yeah, I think so far as the financial institutions are concerned, what Manoj has explained, I mean, it's quite true. This format suits, like, that gives a good idea about the operations of the company, financial, or, banks or NBFCs.
Because as per committee, this format is already so many decades, you can say, not decades.
But again, the trading, if it is an international term, is fine, but treasury is a more appropriate word. Yeah.
I'm sure the Indian, institute and the regulators in India will Indianize it to a great extent, because this is again just an illustrative, as even Bilanjan said, that this is from a global perspective. It's illustrative. The standard itself acknowledges that it's not compulsory, it's illustrative. So obviously we'll tweak it a bit, we'll just do some Indianization for, our terms and
Yes.
but this is what it is.
Yes. It takes care of them. Whatever Indianization takes place, then it will be convincing type
Which
of
is why it's IFRS. When it becomes Ind AS, it will be much more
Right.
Indian.
When it becomes more,
It is absolute.
it will become more acceptable. Then-
IFRS is not just Europe. IFRS is rest of the world minus US.
Correct. It's very vital because it controls the large market cap of the stock.
Okay, so
What about China? What are their standards followed?
well, the last time I checked, they said that they follow IFRS. The Chinese transition to IFRS technology has been kind of a mysterious thing. So they do have a few carve-outs Okay, but if you Google it out and look at it, you don't get a lot of fireworks. So, China has officially adopted IFRS. The Chinese version of IFRS does not officially, so as is the case with many other things in China, this is a kind of a, it's a kind of an enigma that you don't get any publications originating from China with respect to what is the difference between Chinese GAAP and the Chinese IFRS and ISB. So therefore, but then the last I checked, there are a few differences, especially with respect to impairment, especially with respect to real estate accounting, with respect to a lot of other things. But official version is it's as we know, things aren't so transparent in China, so it's we'll have to go there and find out.
Chinese companies which are listed, so information available later in the year, we will look into Chinese companies.
Listed companies, I think that may be available, financial statements. Then he is the right person to do that.
No, all of us collectively, we do because as we said, no, five people make a, today we have 5 experts who are interacting. So, let's put together, collectively we improve each other.
The next important thing in this standard is basically, as I said, the management defined performance measures, okay, or the non-GAAP measures, or some people also call it alternative performance measures. So IFRS 18 defines it as a subset of these measures which relate to entities' financial performance as management defined performance measures. The information related to these measures should be disclosed in the financial statements in a single note, including a reconciliation with the management defined performance measures and most similar specified subtotal in IFRS. So, for example, let's take a telecom company which publishes its ARPU, or average revenue per unit. So the expectation now is, if it complies, if it has to report as per IFRS 18, that whatever figure I'm reporting as ARPUs, I need to reconcile it. So what's my profit that I've reported in the P&L? What's my number of users that I have, worked out for the denominator? And then that is how it will be. It will have to be explained. I cannot just give a figure and then.
Yeah, the way they indirectly, the way they worked out should come out. In the sense that if we are talking about, say, ARPU, then, total revenue divided by number of customers. So it should tally somewhere so that, then it looks like more accepted.
Correct. Another example and more easier example is that of gross merchandise value. Right? Many e-commerce companies, many retail companies use that as a basis to, report non-GAAP measures to the investors or analysts. So how did you get that? How does it reconcile with your revenue figure? Okay, is GST included in that? Is something which you are not, your other transactions where you are merely acting as an enabler or an aggregator, that is included. So again, that reconciliation would be not helpful to the users as to how does it reconcile ultimately to the revenue that you have calculated, and maybe in Indian context particularly, it will be also helpful for the regulators to identify, a company has plus minus kya kiya hai. Is there something that should be taxed which is escaping tax? So I think this is again a very useful and a very thoughtful inclusion in this standard as to, so as I said earlier, some of these measures do not find a place in the main financial statements. They do find a place in board report or MD&A or the analyst presentation, and therefore they are not subjected to audit, or there is no accounting standard with respect to this standard. I think this is a very useful thing. A lot of companies do, in fact, even today report some of the non-GAAP measures, even today. For example, again, telecom companies, many companies do have that in the financials, and therefore they also, subjected to audit. So, but this is again taking it to a different level that they are mandating or non-GAAP.
Yeah, the reconciliation part is quite good.
Santosh, sorry if I can
So-
add on the management performance measures.
By all means, yeah. Please
I
go
think in my view, this would be a game changer because traditionally there has always been a resistance of including these measures, which are basically measures to determine the performance of a particular entity outside the financial statements. We have always seen them in the board reports or MD&A or in the SEBI world on the ICDR and all those things.
ahead.
But
Correct.
inclusion of them from a perspective of a preparer, because you will also need to have those internal controls to say that yes, these are my performance measures, these are how am I computing, and these are actually been relevant for me as well as for the investors. So I think this
No,
would be
absolutely. I think this is one of a major change in the,
Yeah.
Presentation or financial statements presentation that it, has been introduced. And also, coming back to what Manoj ji mentioned in the earlier, some time back, but as auditors also we need to have a lot more guidance with
Yeah,
respect to how do you get it. So today there is a non-GAAP measure which is published in a DRH.
yeah,
And if it's very critical, invariably there will be a circle upon it, which
Yeah.
the LMs, the lead managers will insist on.
Yeah.
And therefore, as an auditor or a practicing chartered accountant, all you can do is perform a kind of a negative assurance and able to, agreed upon procedures and, say that I have cited it from this and this is, tallying with this, something like
Yeah.
that.
Yeah.
As an auditor, as against that, when you are giving reasonable this assurance, it's a lot more onerous, and therefore the auditing standard, I think internationally they are already working on it, but that has to be tightened, especially in the Indian context.
Yeah.
Right, because if my this gross mercantile value has to be reported and therefore audited. What is the inclusion? What is the exclusion? Whether it's consistent with GMV, which is generally used, all those considerations. Whether what are the data points? All these things become very relevant from a assurance point of view. Absolutely.
Yeah. One
I would
slide
like
thing.
to acknowledge a very senior lady, a top professional from a leading NBFC engaged in vehicle finance has joined us. And listening to our views.
Why don't you speak up now?
Carry on, carry on.
Okay. So, no, nothing else, nothing further from my point of view, Manoj. This was all I had on IFRS.
Yeah, but this point, whether the expense is to be disclosed by function or by nature is quite interesting.
It is, but then my sense again is traditionally the institute's approach and the approach that the NC, the Ministry of Corporate Affairs, has generally taken in India today also. See, IS1 permits classification of expense by function. But in Indian context, in India, it is all mandated to be based on nature. So while IFRS 18 has this, and one of the reasons why I don't want to spend so much time on this is that because my gut feeling is that in India, this requirement may not go through. They may just mandate it by nature again because it's easier than for the regulators to catch it. And as Sir said, let's say if it's employee cost and if it's director's salary, which is a significant chunk of that employee benefit cost. So if I classify it as based on administrative or selling or something, then it becomes very difficult for a regulator or an auditor or a user to understand what it is. So they may stick to
But then those employee expenses going into R&D. Okay, now when you are showing R&D separately, And if you are going by the nature, then you will club all types of employee expenses into one head employee expense, right? So it won't give an idea that out of this total, how much is going for R&D
So there are,
efforts.
correct, so
Yeah.
there are pros and cons. So by function, ideally, it will depict better, better visibility of what exactly those people are doing. But the reason why in India the institute and the regulators have not really done it is because it becomes very ugly. Because what a director is doing, and in the Indian context, you don't have time sheets. Okay, as a director, I may be doing so many things. I may be doing, financial reporting, talking with banks, then part of my time will be for marketing. So a lot of things. So how do I, allocate that part? R&D is of course, find some, R&D experts are there that it can be. But for example, if there is a CEO, which is a very significant chunk of your employee benefit cost, he will be doing so many activities, and so to break it up into various functions, it becomes difficult. And from auditor point of view, also it is again a kind of a difficult. So in India, they have generally been persisting with the nature rather than function. Although internationally, we do have examples, right?
I can say in our company, we had different nomenclature. That expenses were activity. So we were to have the expense code, the activity code. So you can get the expense both ways. Let's say if you want to know what is total employee cost, you can get that expense. If you want to know that where all the employees have worked, so the activity code. So the coding was both ways.
Correct.
So with the one code you have both the expense code as well as the activity code. Correct. So suppose somebody goes for projects, and the companies when they are every year, you spend not hundreds, but say in thousands, like say 2,000 crore, 5,000 crore, like that capital expenditure. Then this particular this segregation or information helps to understand the nature of work.
Correct. Okay, so we move on to the last subsection of my session, that is on market. As I said, SEBI has come up with this circular. Manoj, just day before yesterday. That is on not day before, but day before yesterday. That is 21st of May. Where they clarified that the top 250 listed companies that need to comply with this requirement with respect to market rumors will be phased out. The top 100 listed companies will be doing it from 1st June. That is in a span of next few days, next week.
Implemented, ordered.
Yeah, and the remaining 150 entities, listed entities, will be from 1st December 2024. But the change, one of the change, the easier change in this circular is, Manojji, that earlier SEBI said that to do this top 250 calculation, this is market capitalization as at the last March. So, for example, it will be based on 31st March 2024 market capitalization. Now, it is a much more thought through process where they have said that no, that is a static market capitalization. We need to rank these 250 companies based on the weighted average market capitalization and the stock exchange, both the BSE as well as NSE need to publish the rankings based on the average market capitalization for the last year. Okay, so that is a simpler change. The more difficult change in this circular is what is material price minimum. So what it says is, it's not something that you have to calculate based on a point in time. It is on a relative basis. So if on a particular day, if the movement in a share price is significant, but it has been so since last maybe 1 week or 3 weeks or 6 weeks, then it is, it's a linear progression. Okay, not in as many words, but they have illustrated an example in the annexure that they have given in this circular. Very well thought through circular, but of course still a lot of confusion. It will be complex to apply in practice. You will have to calculate material price movement on a relative term. That is, if it has spiked or if it has gone down relative to last, 6 weeks. In that case, you have to identify that this is a material, price movement, and therefore explain the, clarify, deny, or confirm the market. Secondly, what they have done. So 24 hours time limit is still there. 24 hours time limit is still there, Namoji. So when a market rumor has affected, has resulted in a material price movement, 24 hours from that point in time, you have to the management, the company has to clarify the stock exchange. What they have again little bit helpfully done is that the mainstream media. So this market rumor has to be published in a mainstream media. अगर कोई WhatsApp group में चल रहा है, if it's some, so we will say the company cannot identify it public at large.
How do you define mainstream media?
Let me explain. The earlier publication, the earlier circular rather defined mainstream media as all the newsletters, all the news channels which are regulated and registered with the ministry. They have done away with that. Because there are thousands of newspapers and news channels in India. It will be hell lot of a job for a company. एक पूरा department बिठाना पड़ेगा market rumor क्या चल रहा है market में वही find out. It's not doable. What they have said is top 20 English newspapers with national circulation, regional public newsletter, areas where the company has presence. So, for example, if again I am coming back to NBFC, if an NBFC doesn't have any presence in, let's say, east of India, which, for a matter of fact, I know that East India में बहुत कम NBFC. Well, it's a highly risky from a credit risk point of view. Then you don't have to worry about Bangla because you don't have presence. So the top 2 newspapers of the region where you have presence, they will be identified and your mainstream media में आएगा. International media they have persisted with, so all your Reuters, your Bloomberg, your so all those will continue.
Are they included by name?
There is so whatever is registered with the Ministry of Broadcasting, they have. So that is some rationalization.
What about LinkedIn and Twitter? Are they included?
Social media is still out. Social media is still out. So basically, they have rationalized it. Calculation of price, material price movement is still complex. It will be subjective. At least, 3 audit committees which I have attended since last, so this week in fact. Independent directors, the company secretaries have all been very, I would say, have, that share of concerns and. The calculation of material price movement is still, we have to figure out how the first bench of 100 listed companies do. And then the rest 150 will follow. For a group, again, if you're talking about a large group, okay, so I was in an audit committee of a large group which has the highest market capitalization in India on a combined basis, from aviation, salt, software, motor vehicles, everything. The chairman of the audit committee that said that, Santosh, we are going to do it at group level. This cannot be done on a silo basis. If there is a name in the Google okay, of our group, without the motor, consulting service, whatever, that itself would affect my share. If one of the group companies comes up with an IPO, another group company's share price, which has got nothing to do with that company, also automatically. So this market rumor is something which will have to do with that group level, and they have put in place because they have companies in the first trench as well as in the next trench and in the last trench also. So artificial intelligence. Sir, you talked about artificial intelligence in terms of notes to accounts, but again, this is another very interesting thing. And they said that we don't want any consultants, etc. All we want is a few, processors having good capacities to run that, search engine, of artificial intelligence on the server. So on a real-time basis, on a half-day to half-day thing, where the team will get alerts on the mobile phones on what is the rumor on mainstream media which is going on at a group level. The algorithm will further, filter it out for what is specific to you. So if it's something to do with, let's say, airports, the pilots going on sick leave on a fine day, or any issues with that, or the software of a large aviation company which is not working, the scheduling software. If that affects my share price, even if there's nothing that, just that we are in a same broader group, I'll have to identify, it is identified by that method. So super, I think the group has one of the largest software companies in the world in its umbrella. So there are IT brains and technology brains that were worked on, and so that is how. But this will be an interesting thing because again, the very important difference, sir, is that what is a market rumor and what is market sentiment. So if you feel that depending on the number of Lok Sabha seats on 4th of June, let's say a party gets or an alliance gets, the share prices of a group will go up, it will hit the roof. That's not a market rumor, that's a market sentiment. That is a market sentiment. I feel that a particular corporate will gain from, let's say, the UK elections, the way it works, or if Sunak gets re-elected or not, or let's say the US presidential election. That is not a rumor, that I have to clarify, that is a market sentiment. So again, it distinguishes between a market rumor and a market sentiment.
Now I'll add specifically on this.
Yes, please.
In the last 2 days, some chief compliance officers who are accountable for reporting this to exchanges connected with me, and in some cases the heads of finance and accounts who give the information, particularly for this announcements, price impact, they connected with me. The main concern of outlay from the heads of finance, accounting, whom all the branch regional accountants report to, is there was a line on if there is a noticeable change in the price due to a rumor, the listed company must verify and respond to this rumor. Now, who? Chief compliance officer and the head of finance. How they verify the rumor? It may be an impact on a strategic investor coming. Often the news channels or Bloomberg, you mentioned Reuters or the news channel, there are hundreds of them. Let's take a top one. They often flashes, shows a strategic investor coming, so taking. Or also, in case of a pharma company, filing done, ANDA filing done, and this is very, very important. How do those verify? And often this is done by operators who build in positions in one day and they want to upload next day. How do they verify? There is no way within 24 hours, they can verify. And they are accountable in audit committee meetings to auditors also what you have done. Particularly if there is a controversy.
Especially if you have foreign operations. 24 hours is very less if you have foreign operations. Because let's say if some rumor is happening somewhere else. Let's say if I have a manufacturing plant, let's say somewhere in Africa, and in international media, if there is some rumor of some green, violation of some. For 24 hours before I, as a compliance head, figure out as to what exactly is the development. You gave the example. Exactly. So if you gave the example of US FDA non-compliance.
I gave of a company in BKC.
Correct.
Who's a participant is a member of a group.
So if you have a global footprint, you're a large conglomerate or having pharma company with global footprint, which many of our pharma companies do have. How do you figure out and verify the rumor which is going on in some other geography, given the time differences?
See, verification is not difficult. Also, it is easy. It's the timing of the announcement. Often, some people come to know they are going to file it, and then they release it earlier to make the profit out of it.
So all these, correct. So all these issues are there. Let me go back to the intention of SEBI.
I'm wondering whether auditors get involved in it or not.
No. So Niranjan, just give me.
Sure, please.
So here, intention is what? Just to clarify, that some of the companies, some of the promoters, the concern is that the regulator has that some of the promoters are running the rumor. The stock prices are going bonkers here and there, but there is no official confirmation or denial on it by the company. So as per sources, this company is in talks with that company to acquire or business or sell its business. M&A acquisition. Correct. So SEBI came up with this very noble idea that, and internationally it is prevalent. Manoj, in US, if there is a market rumor, you have to clarify. I think the time limit, I'm not sure, but time limit is much less than this, 24 hours. So what SEBI wants is that you cannot be, rumor mongering about your company through media. We know how, some of the media companies and the channels work in India. Getting and boosting your share price or, getting it to fall. But you are not officially confirming anything because it's generally as per sources. So the idea is if you have any market rumor which is circulating in the mainstream media, then you ought to clarify it, confirm it or deny it in a particular time slot. Yes, Niranjan, sorry.
So Santosh, I will, instead of getting into too much technical on this, I think what we should actually do is to applaud the approach which SEBI has taken, especially the new chair.
Absolutely.
I think this phenomenal new way of giving very close to real time information to investors, right? On this is really noble, as you also said. Secondly, what I should also think we should all do is that these requirements were further fine-tuned by a group which again set up by SEBI, which was led by very senior members from the industry. They had this industry forums, right? And they have come up with beautiful guidance. I think you did mention some of them on what is a national daily, what is a market sentiment and a market rumor. They have actually, from an industry voice, they have drafted these guidances, and those guidances, I think if you will look at in substance, I think we would be able to deal with all the teething issues that we are having at present. So I think overall,
absolutely, Niranjan. And as a matter of fact, apart from the industry representation, even there were, on that committee, some of the members, senior partners of, consulting services. Very senior partner in, your organization, who of course is now retired.
Yeah.
And, my boss,
So
Yeah.
some of the best brains in the consulting services were also involved in this, proposition. Your take, sir?
It's required that a company needs to clarify so that everybody and everybody will not be misusing the rumors for the market manipulation. It's the preventive measure, preventive.
Right, sir. So any other thoughts from those of us who are joining on Zoom on Zoom? We heard from Nilanjan. Anybody else who wants to speak or you have any questions on any of the three topics that I've covered? Rohit or Anupam or okay, looks like no questions. So great. Thank you all for giving this opportunity. Thank you, Manoj, in particular, for giving me this opportunity to speak. With that, I end my session. I hand it over to the next speaker.
Yeah, Santosh, I think we have gone into quite in detail and explain about this IFRS 18 and this the profit and loss account, details, formats and all that. And that has given a good insight into the what the regulations are moving to. So thanks for a very good, talk on these topics, which are very important. And now, Mr. Rajendra Joshi, I invite him to start his presentation. Actually.
It's a topic. What you will take it up?
No, what we,
Can you introduce the topic?
yeah, look at the topic and then we continue next.
For which I wanted to state that in bank, whenever there is proposals go to the top management for sanction, there is a board committee or the board. So they sanction the proposal. Now in that proposal, there is a like CMA data and other things are already available, but one needs to look into that. For example, in one company, sales is on rising, right? Thereafter, profit is also on rising, but the current ratio is also improving. So now, when it comes from the corporate branch to the journal office comes to head office, right? So somebody has to take care because borrower also knows my data, right? So if there is nobody looks right, and then we are a chartered accountant, right? If we are working there, we have to look it. Okay, is increasing the sales. Whether it is how it is increasing, is making sales to his associate concern, right? Making sales to associate concerns, right? It was to be looking in different angle. So one company that it was rated A by my branch, when it came to head office, I rated C. Then I rated C. Then that company and that journal of our journal office both went up of my boss GM. He said what your people are doing. You are rated C rating, which is when sales is on increase, current ratio is on improving, right? And thereafter the data is also improving. On all this position is there, right? So how then I stated that when you say sales is on increase, but the person they have acquired some sick units and they made sales to those sick units, right? So this definitely shows the sales upward trend. Right? Another thing, they have not paid to this company. So debtors are outstanding within the group only, which we need to exclude. Absolutely. Exclude, right? And thereafter, this current ratio definitely will improve if you don't exclude those dates, no? Current ratio will appear appear to be very good, right? So these are things that we will consider while doing trade risk and trade office we will exclude that because it reflects the figure and big corporates also know that what data they have to present now to get good rating within the bank internal rating that we do and also the our sanction that will take place. So this is one angle. Another angle is that then I saw the balance sheet that their debentures are actual. And the company is already having liquidity crunch. The liquidity problems are there, right? Then other problems, this that we have studied, no. Then there was a IFCI loan also. IFCI also had given a loan, and they were defaulting there also. They were also defaulting there also. Then there was a SBI loan on with step up rate of interest, right? So all this company is definitely in dire consequences, right? Go also normal course when sales is improving, great, current ratio is good, profit is on increase, right? So when you study detail, you found that this company they do not pay debentures on the redemption, right? Then as per the Companies Act, they lose the directorship. They have to resign from that. They lose the directorship, right? To pay that dues on redemption, no, they have come with the loan proposal.
Absolutely.
Not for that.
So they have done all the phone only the rosy picture so that they can get the loan and then we can repay the debentures and all. So yeah. So the bank has to be very careful analyzing all these various
Not
parts.
just apparent financiers.
Absolutely.
Apparent finance going into apparent financiers, no, then there is a no difference between chartered accountant is working there, right? And luckily my boss also chartered accountant. So when such calls come, no, he because he has signed, he also signed and this goes to the board, right? So he's also answerable. So we don't go that anybody comes, no, I will send to your family and you need to you explain to them in detail. So what is had come to me that visit that time one case I came in 2018 I returned from Canada. So then after one bank gave me that case, they say, okay, you have exported, but money that they have not received the money. Company has exported, but they have not received the money. When they have not received the money, then this company, as per the new digital that government has introduced, now government has introduced that is called EDP. This bank can have a view when you export the good, right? So there is the entry in EDP, this borrower has taken the facility, then they are exporting the goods. Now, when they export the goods, so suppose they export from Chennai port, right? So Chennai port authorities also will make an entry. Okay, these goods have gone from our port. So this is second confirmation that goods have actually left the port. Right. Now, when goods have actually left the port, no, then the position comes on if it is given credit for 180 days. After the 180 days or over, no, that time then this authority bank will start asking that borrower, their money has not come. He says he is also following up, the money has not come. Then in third case, what will happen? No, that after 1 year is over, some authority also rises nowadays. That is the advantage of digital, because they also find that
What is the time frame RBI is allowed?
there are two time frames. One, the borrower is allowed, or the bank is allowed to the borrower, and customer also is allowed to that buyer in abroad. Right? So that timeline is came up. But generally, RBI is not beyond 180 days. Not beyond 180 days. Still, there is a further 6 months of follow-up is there. After that period is also over, no? Customer authorities also will find these goods which are left India, for which foreign exchange is to come, and it has not come. Then
But how customs keep track of this foreign
they have
inward remittance?
when inward remittance comes, no, EDPS bank will send. Okay. EDPS banks come. So everybody comes.
So they come to know.
They come to know. This is the major advantage of digital. Like earlier, no, they used to get the money through that Hawala, right? So stop Hawala is EDPS very useful tool actually for the bank. Now, when we are auditing, no, or when we are assessing credit risk, so this how to know when this there. The case that was given to me, it has reached the limit, so that bank has stopped the exporter facility as a packing credit rate. So it will be under normal cash credit rate, like domestic borrower. They told me, you go and find out why this party is using all the benefits actually as exporter, because they are not given the insurance or any other thing not available to them. As an exporter, incentives are not available. 50 crore, right? When I went there, no, then I found that they are not bothered about the money not coming. And another thing, because they already received the money. They receive the money. Now what they do, they get the exporters have insurance policy, no? They get claim also and they balance amount write up also. So additional loss was there earlier. Not this paper. That this paper case, no, they've been paying this the company, no, that I went. There are many services. So earlier were successful to make banks including the nation. Because the foreign exchange their mission is to either Hawala, Dubai or some other China, right?
Yeah, and sometimes the exports are not to the ultimate buyer.
Yeah.
It must be to intermediate. So again, there the profit is booked somewhere else. So all these things are possible. So I think, Mr. Rajendra, it looks like your topic is credit risk and analysis is very interesting, and I think we can deal with it in much more detail. Possibly, so to speak in next session.
Yes, we will in next session. That because it is a very lengthy and I wanted to have lot of examples. Right?
Yeah, that's very interesting.
So my this Mr. Santosh has done very well this presentation, and for me, no, I wanted to encourage our chartered accountants. No, so I tell you, I have done just to MBA Institute. Right? When I go to the MBA Institute, this like finance and management, no, the students are mostly engineers. Right? To see the impression of the
Yeah. So many, I would say, so many such terminologies that come from MBAs only. Those who are dealing with this, venture capital or those kind of thing. So there will this gross what do you call the revenue, what you say, for the startup.
Gross monthly.
Yeah, so what is this concept? Gross monthly, there is no way to bottom line to show. So, what way they can get more money?
So many areas are there, no? So in bank also was branded negative. I would say, other banks, they will get, so they will push. Even my GM also said, "Hey, you see that?" But what happened now after 2 years, we see the push classification of asset classification of that account, no? Which is one pair they have done, no? So chartered account is conservative, but they should also learn certain techniques of presentation. So credit rating is the area, no, where we can our chartered accountants or one chartered accountant to take part. These are capable, so they are good at presentation. You can achieve this very detailed one.
See, they will always give rosy picture. They will always give optimistic. We have to go through
Realistic and conservative.
I would say conservative, realistic. So when you are expanding something, you can be little conservative, but when you are talking about future growth and the market, what will the company will capture and all. So there you have to be realistic, going by to your various other companies, what in the business they have been able to do, how they scale that, or what is the possibility. So you have to kind of realistic view you have to take. So great, I think. Yeah. So we'll conclude today's session.
Right, sir. Thank you so much.
Yeah, thanks, Santosh, thanks, Rajendra, thanks, Manoj.
From a vote of thanks by you.
Yeah, so Santosh has given real good, what do you call, details about the IFRS 18, plus what are the management performance measures, and what about the market rumors. So all the three topics are quite interesting, important from the investors' point of view as well as the financial point of view. So great, Santosh.
Circular.
Yeah, circular.
Circular. All regulatory updates.
Yes, and IFRS 18.
Thank you.
All in all, great presentation. So thanks. Yeah.
Thank you. Thanks for the opportunity. Always a pleasure.
And
Yeah.
your words.
Yeah, Rajendra, I think
your mention for Rajendra and for the PR chairman.
Yeah, for Rajendra, I think the topic is really good, and he's elaborating it, going into details to throw light on how the NPAs take place.
How to stop it?
Yeah, and how to stop it. So very interesting, and thanks, Rajendra, your efforts and your presentation will take up the next session. Thanks for joining us for today's session, and thanks Nilanjan also that your input was very useful. It gave much more insight into the relevant points you raised. Thanks, Nilanjan, for joining us. And we thank WRC chairman also for for today's session, which was enabled. And we could reach through internet through a lot of other members who are not physically present here. So thanks, WRC chairman also. Thank you.
Things are very nicely. Nice meeting you. We'll catch up. Contact.